day and following peace to all. So for today, together with my group mates, we will be presenting to you our investment proposal. So here's the given problem. So we have here a 100 million pesos excess liquidity that cannot be reinvested into the operations, and 80 million pesos existing debt with 1% interest per annum for a term of 5 years. And the inflation is expected to range from 4% to 8% for 5 years. And now, we are looking, or our goal is to look for the best investment on the following options. So first is the S&P index, second is the PSE index, third is gold, it could be paper gold, the fourth one is Bitcoin, fifth is the Philippine Treasury bonds, sixth option is to pay off the debt, and lastly, US dollars. So the investment is all in and only one investment choice with an investment horizon of 5 years. And you also have to consider taxes and foreign exchange conversion and use the historical data of 10 years as basis for the calculations. Based on the given investment options, we are opted to choose only one, and that would be the best investment where it would provide the company the highest probability of its future cash flows based on a 10-year historical data of a particular investment option. So in the given problem, the inflation rate ranges from 4% to 8% for 5 years. If you look at the investment perspective, the rate is a bit high and too risky to invest the money, especially when the rate for those investment options is volatile. Inflation refers to the rise in the overall price levels. With moderate inflation, this is associated with the growth in economy, while high inflation signifies an overheated economy. So considering the inflation rate when it comes to investment is very important, as it poses a still threat to the investors because it takes away the investment returns and real savings, right? So generally, investors aim to increase long-term purchasing power. Hence, inflation puts this goal at risk because investment return must first keep up with the rate of inflation as a means to increase their real purchasing power. So if the inflation rate is much higher than the investment return, then it will produce a negative return to the investors. Let's tackle first the first investment option, which is the S&P 500 index. So as you can see in the table presented, that is the 10-year historical data of S&P 500 index, for which the abbreviation stands for the Standard & Poor's 500. In the United States, this is a stock market index that tracks 500 publicly traded domestic companies, and it is considered by many investors to be the best overall measurement of American stock market's performance. So the table showcases the beginning and ending prices of their stock, and each year there is a significant annual change on their prices. So looking at the financial perspective, investing in S&P index is risky because there are times in 10-year given data that has a negative annual change, which could greatly affect the money that has invested over time. The second investment option is PSE, or Philippine Stock Exchange Index. So Table 3 displays the 10-year historical data of PSE index. This is a stock index in the Philippines, and it forms part of the Philippine Stock Exchange, or PSE, and includes almost all the common stock listed on the exchange. The annual percentage change of prices in PSE index is good because if you purchase earlier than this year, such as in 2010, the beginning price is much lower than its ending price in the following years. And as you can see, there is a sudden annual change for the years 2014, 2015, 2018, and 2020.
Hi, good day. This is Minglana. The next investment options that will be tackled in this video is about the gold. So Table 4, as shown in your screen, displays the 10-year historical data of gold. So based on research, when it comes to gold, high liquidity and inflation beating capacity indicates a strong selling point. The prices soar high when the markets face turbulence. And based on the given data, there are years or phases when markets witness a fall in gold prices. But that won't last long because such as in a year 2013 to 2014, as shown in the given data, the prices in gold falls down, but after those years, it suddenly goes up. And research shows that though the prices in gold falls down, it would always make a strong comeback. Next is the Bitcoin. Table 5 displays the 10-year historical data for Bitcoin. This is often described as cryptocurrency and a virtual or a digital currency where the type of money is completely in virtual. So based on research, investing in Bitcoin or in cryptocurrency can be a challenging, especially when there is a high or large fluctuations in its price. So buying in Bitcoin also carries risks as the price could drop precipitously. Next investment options is the Philippine Treasury Bond. Table 6, as shown in your screen, displays the 10-year historical data for the Philippine Treasury Bond. Treasury bonds are often for long-term associated with low-risk instruments which are direct and unconditional obligations by the government of the Philippines. Looking at the 10-year historical data, the yield in percentage is a bit low compared to the inflation rate that ranges from 4% to 8% for the 5 years. The fixed rate for a 5-year treasury bond in the Philippines according to the BSP is 3.375%. US exchange rate to Philippine peso. So the table 7 displays the 10-year historical data for the US exchange rate. Based on research data, foreign exchange rate or exchange rate is an unavoidable risk of foreign investment. The exchange rate risk is caused by the fluctuations rate in the investor's local currency compared to the foreign investment currency. These risks can be mitigated through the use of a hedged exchange traded fund or by the individual investor using various investment instruments such as currency forwards or futures or options. Exchange rate risk isn't completely avoidable, but it can be mitigated.
And for the last investment options is what we call the pay off the debt. So pay off the debt refers to an option to pay the existing debt that the company loans. So meaning the 100 million excess money will be used to pay the debt rather than it investing in other options just like in Bitcoin or PSA and so on. Basic investment concepts to help in decision making. There are various concepts which are considered very essential when it comes to investing and creating wealth. Understanding the investment concepts that drive markets in investment and also the impact on making decision process is very crucial to ensure that we keep our line on track and therefore achieve the organization goals. So considering this investment proposal, we do various research on concepts that impact the investment decisions as this may help. So in this investment proposal, we identified several of the most common concepts to be aware of with the basis of research. So the basic investment concepts will be discussed by the next member in this group. So that's all for my part. Thank you.
The first investment concept is the risk and return. In an investment context, all investment carry a risk. Investors make investment in an effort to raise or grow their money. Hence, they are expecting returns from the investment in a certain future year. Nevertheless, the future is very uncertain. It is the uncertainty for which return is associated into the produces the risk into the project. The second investment concept is the dollar cost averaging. The dollar cost averaging is also known as constant dollar plan. Is a strategy for investment for which every investor divides the total amount they want to invest across periodic buying of an asset in order to scale back the impact of volatility on their overall purchase. Moreover, dollar cost averaging is an approach that periodically investing a specific amount of money, even without considering the market price of the type of securities being bought or purchased. It is commonly associated with investing the passive strategies that allow the investor to cut back down the time they supposed to spend in administering their portfolios. According to research, this DCA can be applied for any types of securities, but it is widely and commonly used in pooling investment vehicles like index funds, mutual funds, and exchange traded funds. Why did they use this dollar cost averaging? Well, there are investors use DCA because it scales back the effects of their market's timing and investor psychology on their portfolio. To sum up, dollar cost averaging forces the investor on purchasing a set of money periodically regardless of the price. The third investment concept is the compound interest. Compound interest, in simple terms, it both the interest earned on the money invested and the money being saved either in banks, and it's also referred to the interest earned on the interest. It is the money that is making more money, as what they said, that when it comes to investing, you let your money work for you. The compound interest can be a different schedule such as monthly, quarterly, or annually. According to research, the higher the number of the period is compounding, the higher the interest. Compound interest causes the money to grow more and faster. The fourth investment concept is the risk diversification. Risk diversification is a strategy for investors to manage the risk through allocating the investment over financial instruments or other categories. Diversification aims to maximize and utilize the return by investing in different areas, which would make each react to the same events differently. Every investment consists a risk and it is unavoidable. However, the risk exposure can be managed along with the right strategy in order to scale back major losses. The best and simplest way is through diversification of investment and spread the risk, diversifying the investment to a different class of assets such as bonds, stocks, or share, etc. The fifth investment concept is the inflation. Inflation rate refers to the rate of prices in goods or in services. It occurs when there is a rising in prices due to increasing production costs, like in wages and materials. When there is a rise in prices, it affects everything, our cost of living, etc., which leave a dent in our investment and savings. The rise in inflation may not rise at the same rate for the investment. Therefore, sudden increases in inflation but intense pressure on the investor. The return rate of the investment must beat the inflation rate because if the return on investment is much low compared to the inflation rate, then the money being invested is worthless. Observations. Given the respective 10-year historical data, we notice that their prices are dynamic. We consider the risk and return of the following investment options, as this provides a higher risk but some investment option will potentially give higher returns. The greater the potential returns it provides, the greater the risk you take. The protection against risk is time, as what we have noticed on the given data. The stock market prices can go up or down eventually. How does inflation rate affect on the investment options? Based on research, inflation can have a mixed impact when it comes to stock. The inflation rate will typically get high when the economy is strong. Companies may be selling more of the stock, which could help their share price. Nevertheless, company will incur much money for paying more for wages and raw materials, which could hurt their value. Whether the inflation will help or hurt a stock, it will still depend on the performance of the company behind it. Conversely, investing in gold historically do well even if inflation is high, as the value of the dollar goes down. It would cost more dollars to buy the same amount of gold. But the thing is, given the thought that when we invest the money in gold upon comparing it with the stock, an ounce of gold will always be an ounce of gold. But when we have when you have a share of stock of a well-managed company will no longer be the same value some years from now. Lastly, investment like Philippine Stock Exchange Index and S&P 500 Index. These investments are indexed for inflation rates. According to research, investment that is indexed can earn more when inflation goes up and less when inflation goes down. So we have here the comparative analysis. This is the investment option to compare. We have here the P of debt, Philippine Treasury bills, and Philippine Stock Exchange PSA. So, the first option is the pay of the debt. As you can see in the table, there are three parts of the given data: the financing, inflation, and the tax rate. In financing, it is composed of total capital, total debt, total equity, and interest rate for existing debt and the interest expense. The total equity of 20 million was calculated by subtracting the total capital of 100 million and total debt of 80 million. This is also the need to calculate the interest expense for the 5-year horizon of the cash flow. It is amounted to 4 million by multiplying the total debt interest rate of 1% at the years of forecasting, which is 5. In terms of inflation, it is given that the expected inflation rate for 5 years is within the range of 4% to 8%. Meanwhile, of the tax rate used in 25%, which is the general tax rate for domestic in the Philippines.
In the case given, there is a need to compute the WACC in order to solve some parts during the forecast of cash flow in the next 5 years. Prior to analyzing the weighted average cost of capital in this investment, understanding the capital structure comprises the first component. The company's capital includes equity and debt. Debt, in simple sense, comprises what we call interest-bearing debt, which means that not every liability is considered debt, rather only his liabilities that imply paying some forms of interest, such as bank loans, are considered debt. Combining the equity and debt in this investment proposal establish a total of 100% of a company's capital. Consequently, the capital structure refers to the weight that equity has within capital and to have weight of debt within the capital. Based on what we have learned during our financial management course, a company's weighted average cost of capital is how much it pays for the money it uses to operate, is stated as an average. It is also the minimum average rate of return it must earn on its assets to satisfy its investors. In other words, the amount the company pays to operate must approximately equal the rate of return it earns. The cost of capital is how much a firm pays to finance its operations through debt sources, equity sources, or some combination of the two. If a product or an investment project is privately financed with debt, the cost of debt will have a higher weight. And conversely, if the product is financed with equity, the cost of equity will have a higher impact. The cost of debt component includes a third factor that considers the fact that interest expenses are tax deductible and the cost of debt is lower than it seems as it provides borrowers with a tax shield. What happens if the project investment is financed by debt in WACC or equity? Based on what we have discussed in our financial management course, the weighting varies based on how the company finances its activities. If the value of a company's debt exceeds the value of its equity, the cost of its debt will have more weight in calculating its total cost of capital than the cost of equity. If the value of the company's equity exceeds its debt, the cost of its equity will have more weight. To sum up all, cost of equity is best to use when the investment is purely financed by the money or the capital through its shareholders of the company, while cost of debt is best to use as a discount rate if the investment project is purely financed by borrowing funds. In order to get the weight of debt of 0.8000, the total debt of 80 million is divided to the total capital of 100 million. On the other way around, to get the weight of equity of 0.2000, the total equity is of 20 million is divided to the total capital. The cost of debt of 1% is coming from the interest rate of the existing debt. Meanwhile, the cost of equity of 3.375% is coming from the fixed rate of Treasury bond for 5 years according to BESP's Special Data Dissemination Standards. To obtain the WACC of 0.110625, get the product of the weight of debt and cost of debt, and then add to the product of weight of equity and cost of equity. Then after getting their products, multiply it to the difference of 100% and 25% of tax rate. With the matter of forecast for the next 5 years, cash flow, there are 3 cases which are worst case, base case, and best case. So in this illustration, the case is in worst case, which is to not invest. So in that case, the firm would miss the golden or favorable chances if it denies engaging to invest. In order to solve the present value of cash inflow and outflow, there is still a need to calculate the nominal rate. The nominal interest rate does not account for inflation. In other words, it is not inflation adjusted. It can be calculated by getting the sum of 1 and the WACC, then multiply it to the sum of 1 and the expected inflation rate of respective years. After getting the product, subtract it to 1. The nominal rates are 5.150%, 6.162%, 7.173%, 8.184%, and 9.195% from year 1 to 5 respectively. The base case scenario is to pay the existing debt of 80 million today. By paying debts now, it generates an NPV of 12,883,124.51. However, in terms of our current projection, it reveals that the company will forfeit such savings that might happen when the loan is retained and use the money to investing. In the best case scenario, if the company uses the money of 80 million to invest rather paying to debt, the company may able to generate tax savings. Thus, the best case scenario is to pay the debt of 80 million after 5 years. Today, the money should be invested in order to save money on taxes on interest payments which can add to the NPV. By paying the debts after 5 years and invested, the company may able to generate an NPV of 13,011,955.75. And now, let's talk about the second option, which is the Philippine Treasury bonds. As can be seen in the table, there are 4 parts of the given data: the financing, inflation, tax rate, and the coupon rates for Treasury bond. In financing, it is composed of total capital, total debt, total equity, interest rate for existing debt, and the interest expense. The total equity of 20 million was calculated by subtracting the total capital of 100 million and total debt of 80 million. There's also the need to calculate the interest expense for the 5 years horizon of the cash flow. It is amounted to 4 million by multiplying the total debt, interest rate of 1%, and the years of forecasting, which is 5. In terms of inflation, it is given that the expected inflation rate for 5 years is within the range of 4% to 8%. Meanwhile, on the tax rate used is 25%, which is the general tax rate for domestic in the Philippines. For the coupon rates for treasury bonds, it is divided into 2. The fixed rate for a 5-year treasury bond, which is 3.75%, and a fixed rate for a 10-year treasury bond, which is 4.750%. Good day everyone, this is Bambie Montilla. For the continuation, we are now in the table of weighted average cost of capital. In the case given, there is a need to compute the WACC in order to solve some parts during the forecast of cash flow in the next 5 years. In order to get the weight of debt of 0.80, the total debt of 80 million is divided to the total capital of 100 million. On the way around, to get the weight of equity of 0.20, the total equity is of 20 million is divided to the total capital. The cost of debt after tax is the 1% coming from the interest rate of the existing debt multiplied to the difference of 1 and the tax rate. Meanwhile, the cost of equity after tax is coming from the fixed rate of treasury bond for 5 years, which is 3.375%, according to BSP's special data dissemination standards, and multiplied to the difference of 1 and the tax rate. To obtain the WACC of 0.110625, get the product of the weight of debt and the cost of debt, and then add to the product of weight of equity and the cost of equity. On the next table, it is the 10-year historical data based on its coupon rates. As we can see in the table, in this case, it opted to invest whether in a 5-year treasury bond or in a 10-year treasury bond. Based from the 10-year historical performance of the Philippine treasury bonds, it resulted in the table that the best option to invest is to invest in a 10-year treasury bond. And now we are in the forecast for the next 5 years or the cash flow. So we have here 3 cases, the worst case, base case, and the best case. In the worst case, it is to not invest. Meaning if the company will not invest to Philippine treasury bonds, the company shall miss the opportunity or favorable chances to gain future cash flows, whether in a 5-year or 10-year treasury bond. In the base case, in order to solve the present value of cash inflow and outflow, there is still a need to calculate the nominal rate. The nominal interest rate does not account for inflation. In other words, it is not inflation adjusted. It can be calculated by getting the sum of 1 and the WACC, then multiply it to the sum of 1 and the expected inflation rate of respective years. After getting the product, subtract it to 1. The nominal rates are 5.150%, 6.162%, 7.173%, 8.184% and 91.195% from year 1 to 5 respectively. The base case scenario is when the company invests to a 5-year treasury bond. By investing to a 5-year treasury bond, the company may able to generate an NPV amount of 66,589,649.80 centavo. However, in terms of the current projection, based on the 10-year historical performance, it revealed that the company will gain an additional amount of NPV if it invests to a 10-year treasury bond. And for the best case scenario is when the company opts to invest to a 10-year treasury bond, given that the company will generate an NPV amount of 78,994,734.16 centavo, which is a higher value compared to the base case's NPV, adding 8.52% from the base case. And for the third option, it is the Philippine Stock Exchange. Stocks are ownership shares in a corporation. The stock market is a marketplace for buying and selling equities. The Philippine Stock Exchange, or the PSE, is an organization that oversees the stock market in the Philippines. As you can see in the presentation, it is the stock index past performance, and it's noticeable that as time goes by, the stock index keeps on rising. Now we are in the stock price target of Jollibee Foods Corporation. As can be seen in the table presented, the highest stock price of Jollibee Foods Corporation is 250, a median price of stock of 220, and a lowest stock price of 140. The average stock price is 209.68, and the current stock price of the Jollibee Foods Corporation is 204. And for the given data, as presented, we have a total excess of money worth 100 million, and we've decided to purchase stocks from JFC with a total of 490,196.05 JFC stocks. Considering the rate of return of 4%, the NA investment for the first to fifth period is 103,860,000, 107,868,996, 112,032,739.25, 116,357,202.98, and 120,848,591.02 respectively. And for the recommendation, contrary to popular assumption, we are not too young to begin investing as college students. The majority of people are unaware of how important investing is for students. Students who invest while still in school are, in fact, building the foundation for a wealthy future. Our group decided that it's really best to invest the 100 million excess of money in the Philippine Treasury bonds because it provides a predictable income stream. Treasury bonds, as we all know, are indeed a good investment, particularly for those seeking for safety and a fixed rate of interest paid semi-annually until the bond's maturity. Furthermore, unlike the other investment options, such as stocks, which are more volatile and riskier, bonds are an excellent option for people who don't want to be exposed to the risk of equities. That's all, everyone. Thank you so much and God bless.